In June, we spoke with companies that had to pivot due to the pandemic. And so today, we're going to be looking forward and moving past the pivot and into what the future holds for M&A. We do have a few housekeeping items to go over before we begin. You have been muted and your video has been switched off for the time being. Our ACG staff will be turning your video back on, and you will be able to unmute once we move into the networking portion. So the first bit you'll be off and muted. If you have a question for the panel, please use the chat box function and send them over. We will have a Q&A at the end of the panel. If you have any other questions or issues, please send a private message to Brittany or Christy with ACG DFW in the chat screen. So first, I'd like to take a moment and thank the YP committee who put the panel together. Our DF chapter is so lucky to have dedicated individuals who want to bring value to everyone who attends our event. So thanks to the YP committee for everything that you do. Speaking of value, our members are the true reason we're here. So it's my honor to welcome our new members in attendance. I believe we have 10 new members in attendance. I'll refrain from listing them all off, but know that we are absolutely thrilled to have you here. Speaking of new members, if you know anybody that wants or you think should become a member, we have a great referral program for our members. If you refer a new ACG DFW member, then you are immediately registered to be the referral star of the quarter. And so we're here for ACG DFW is here to help you shamelessly promote yourself to the ACG universe. So let us help promote you as a thank you for promoting ACG and maybe becoming that referral star of the quarter. Also, we cannot bring you these outstanding content programs without the support of our annual growth sponsors. Thank you to our 2020 and 2021 ACG DFW chapter growth sponsors. So first, Calvetti Ferguson, you'll see behind us. Thank you, Calvetti Ferguson, for your support. We know you have a few people in attendance today. Please make sure to thank them for their sponsorship during the networking. And also, we'd like to thank our gold sponsor, BDO. For your continued support of ACG DFW. So, okay, I know we're all ready to get started. So just so you know how this morning will flow, we'll begin with the panel discussion, move into your questions that you've submitted into the chat box, and then we'll finish with the structured small group networking. You can sit back and relax until we move into the networking portion, and you'll be requested to turn your video back on. Once you do that, you'll just need to click the button, and once you move into your breakout room, you'll need to unmute yourself. But we'll continue to have instructions throughout the morning, but that's it. So now to the good stuff, and we can get on with this program. I'm very happy to introduce today's moderator, Ernest Simons, an attorney with Perkins Coie. Ernest has a vast knowledge of the middle market across all industries, as well as a depth of experience in M&A. Ernest, thanks for moderating today, and I'll turn it over to you.
Great. Thank you, Kayla. As Kayla said, I am a senior associate in the Dallas office of Perkins Coie, corporate M&A lawyer, and do a lot of middle market deals. And we also advise public and private clients on a number of corporate matters. I'm happy to have with us today 3 great panelists who I'll let introduce themselves, starting with Amanda Foyt.
Hi guys, I'm Amanda Foyt. I'm Vice President of Stone Tower Capital here in Dallas. I've also been a member of ACG for over 6 years now and absolutely appreciate the network that ACG provides and have always been an advocate for the organization. So thanks for having me. A little bit about Stone Tower. So our firm is comprised of 20 people, all based in Dallas with a diverse range of experience, including corporate finance, restructuring, chief restructuring, as well as energy transaction advisory and investing. As some of you might know, Stone Tower was formed by executives from my previous firm, NTA Riverbend and Petro Capital Group, as a direct response to this pandemic. Our practice was launched in June of this year in an effort to meet the demands of middle market companies going through major changes during this time. Our primary focus is to provide unique capital solutions for middle market companies across a wide range of industries and throughout all stages of the business life cycle. Most of our clients are either seeking an exit strategy or capital partner to support special projects, growth, refinancing, or restructuring efforts.
Great, thank you. Mark Friday.
Thank you. Yeah, I'm Mark Friday. I'm Managing Director with Cathexis Ventures, and Cathexis Ventures is the venture arm of Cathexis Holdings, a family office based in Houston. The family is really just two people. It's William Harrison and Nikki Eslami. Nikki is a self-made entrepreneur in the beauty product space, e-commerce, influencer marketing, that whole world. And William inherited an oil and gas fortune, which we've now diversified into data center construction, private equity, we'll do real estate, and of course, venture capital. It's a small sliver of what we do, but it's very exciting work. We primarily look at seed stage companies. That would be a company that may only have a couple of people working on it at the time. Maybe they have more like 15 or 20 employees, but very, very early companies that are growing fast, hopefully 400, 500% year over year. And because of the diverse backgrounds of William and Nikki, who are in their early 30s, they're still very young, we're fairly sector agnostic on what we will look at. We don't do too much biotech, but really anything else we could consider an investment in. And we love to collaborate, we love to share deals. So, you know, it's very, very much an open and sharing environment for Cathexis Ventures. We've invested in over 40 companies over the last several years, and actually we just found out this week that one of them is about to IPO. So they went all the way from just a few people to IPOing in a little over 2 years, and so we're very excited about that. Love to talk about startups with anyone who's interested in technology and software and you know, innovators. But yeah, hopefully we can get into some of that today. Thanks.
And our last panelist is Michael. I'll let him introduce himself as well.
Thanks, Aaron. It's really great to be a part of this today, so thank you for including me. So I'm Michael Hirschfeld. I work with Profit Equity. We're a private equity firm based in Southlake, Texas. We've got about $750 million of assets under management currently, focused on lower middle market companies, more in the manufacturing, industrial, and kind of dealership type business models. So we're really focused on underperforming full potential businesses, kind of not technology based and not restaurants, retail, and real estate are some of our key themes that we try to stay away from, and we try to focus on more of the blue collar industrial type businesses. And so happy to kind of talk about, you know, today how we've really accelerated and pivoted over the past little bit.
Well, great. As Kayla said, we're from different parts of Texas, and we bring perspectives from different industries. Michael doing a lot in the private equity space, Mark with venture capital, and Amanda with restructuring. So I believe in June, we talked a lot about pivoting because of the pandemic. So I'll direct the first question to Mark, and then everyone can feel free to chime in from there. But Mark, what's something that you've seen, a trend that kind of developed maybe because of COVID that you expect to last when we reach, you know, finally a post-pandemic world?
Well, in the venture capital space, companies have been maybe very aggressive in their growth. You might grow at all costs. You might not pay attention to unit economics. You might do some things that leave more conservative investors scratching their heads a little bit and kind of rolling their eyes at the industry. And I think for good reason. Companies had gotten a little bit out over their skis. There's an article in the Wall Street Journal just this past week about how Airbnb, you know, had to kind of step back from the brink. They had to cut 25% of their workforce, but some of the other things they cut were pretty interesting. They were getting involved in making movies and TV shows. They were really exploring a lot of things that were non-core to their business. You know, that's for maybe a company that's no longer in the VC realm, but a little bit further along. But in the startups that we've seen, businesses have focused more on a path to profitability, thinking that maybe the next round of investment funding that we get might be our last. And so they're now building their businesses where they have the option of profitability a little bit earlier. They still want to try and grow, you know, several 100% year over year, but it's probably not going to be with business models that don't have good fundamental unit economics. It's going to be just a little bit more conservative, I think, as we move through this period of uncertainty. So everyone kind of locked down in that way. But then we saw that these software companies were doing quite well, and some of them were actually being helped, believe it or not, by the pandemic. Remote learning software, all kinds of different things, as we've all started to work on our computers, or through our computers, even more often. So it's been a little bit of a mixed bag. Travel companies, for example, you know, if you're a travel software company, it's very, very hard times. But if you're Zoom video conference, you know, I wish I had bought that stock about 7 months ago, right? So it's a mixed bag, but venture overall has been very fortunate to, you know, be able to kind of weather the storm just by nature of, you know, software companies aren't necessarily as impacted by a pandemic like this. So honestly, we're just very lucky.
You mentioned remote learning, thinking relatedly about remote working. Michael, how has the pandemic and remote working affected kind of the diligence process as you look at potential companies to buy or to invest in?
Yeah, I would probably say early on, everyone's still trying to figure it out. And I think kind of where we are today, we've actually found a way to embrace it and really accelerate it a little bit more. I think one of the key things coming out of it too, what we've seen is just the ability to get our managing partner in front of new deals and kind of new management teams. And so you kind of have key decision makers at the table to make decisions. And so that's been able to really help accelerate a lot of the actions going on here internally, but also at our portfolio companies. I think one of the greatest assets that we underutilize is speed as an asset. And so for us to really engage a lot faster with management and really be able to retool and recalibrate and re-engage in a lot of these businesses has really accelerated a lot of our value creation initiatives, which has been very encouraging on a lot of different dimensions.
If you had any deals closed during the pandemic, have you heard anything from your clients about the integration process and any difficulties there if you can't travel, and you know, just the aftermath after the deal closes, how the integration process has been?
Yeah, from the integration, we haven't closed anything during the pandemic, but I think we have evaluated a lot of new deals, and that's been, you know, mostly via remote activities. But even kind of as I kind of fast forward, I think post future acquisition, you know, I don't really see any integration challenges, because you think about a lot of the businesses that we focus on, they're actually, you know, kind of back at work. I think there's kind of a little bit of a balance, and so we'd be happy to kind of engage more on site on that dimension. So I don't really see any issues. I really think it's the opportunity to touch base a lot more frequently and more reps is actually more helpful than maybe kind of the old days of doing it. So it's actually we see great opportunity coming out of it.
So Amanda, what's the experience been like in basically a company developing a new line of business or just opening in the middle of the pandemic?
So, I mean, it's a challenge with everything being remote if you're not critical operations or essential. I think that you can use a lot of tools that are coming up in the market that are virtual and application based that can promote new service lines, bundling digital offerings, and doing things of that nature through a lot of various platforms. I think that it's been actually interesting to see. I think there's been a huge opportunity for a lot of companies to monetize digital offerings where they found that as a challenge before. You know, usually it was kind of a supplement to an offering or something that was thrown into a package. But now that is something that we're seeing middle market companies being able to monetize and grow a new segment, revenue segment under.
And we have kind of danced around it, but I'll open this up to any of you who have an answer. Have you added any kind of tools to your tool belt that you think will develop into best practices that you'll use moving forward after the pandemic?
I think one of the things that we kind of added is really, refocusing on some of our hiring practices. And so we've kind of outsourced really some diligence parties on the people side, on really screening those, doing 360 reviews, disc profiles, et cetera, to really enhance. We're really taking this up as an opportunity to really focus and double down on our leadership teams and build those. We've seen a lot of opportunities to recruit better talent at certain companies. And so that's really helped us kind of augment and rejigger kind of our growth forward plan on a lot of companies. And so we're really trying to accelerate that dimension internally and to the portfolio companies.
And I would say embracing digital outreach a little bit more. You know, networking events used to be going to something in person, and then maybe you met someone in person and they introduced you to some other folks, but it all started with in-person meetings. And that sort of had a structure to it, almost like branches on a tree. Like I had my network, it was the tree trunk, and then everything kind of branched off from there. And then when coronavirus happened and everyone's on these Zoom happy hours and networking events, kind of like this one, where you just get introduced to a lot of people that you might otherwise not have met. And I'd like to continue to embrace that, because I really have met a lot of great people with this new method. And really, hopefully we can all kind of carry that forward and find ways to connect and be comfortable connecting digitally, even after we're all hopefully allowed to get back together in person very soon.
Yeah, I definitely agree with that. And I mean, as far as tools and skills that have been picked up by our team at Stone Tower, I think that a lot of our partners that were not receptive to adopting technology or different tools and resources that were available are really listening now, which is really great. I think we've always had the goal of implementing a new technology that benefits our clients and our internal organization and efficiency. One new technology a year will help grow kind of the firm is the thought, but it's always been hard to adopt. But times have really made it of the essence to integrate those practices and be more efficient for sure.
So Michael, in terms of financial modeling, as you're now looking at new deals, how do you approach financials? Kind of looking at historical financials, are you at all skeptical that some companies are able to recreate their past performance? And just looking forward, how they can fare in the kind of the economy that is to come?
Yeah, it's a great question. I mean, I have a love-hate relationship with financial modeling in the sense is the great part about it is, what do you want it to say? And so you can make the Excel say whatever you want. I think for us, it's really being very skeptical of the forecast and really understanding who built it. I think a lot of times what we find is you keep digging into a lot of these businesses, you really kind of find out that the investment banker is really the one that built the financial model. And that really is going to show through on your leadership team. If you have a really great leadership team that's built it, they're very more cognizant of, what has to be true to drive to that forecast. And so really asking better questions as it relates to that and being very critical on kind of what the future holds and being very skeptical of just because you did X in the past doesn't mean you're going to do X plus Y in the future. And so we're really pushing down harder on rebuilding bottoms up, on more granular detailed analysis, especially in that first year. I think we're trying to really find out, okay, is this really possible? And really scrubbing the financial performance over the kind of during the COVID time period. And where we get a little bit more excited is if we can kind of, understand in a better way, does the company have strength through COVID? That's very interesting for us to kind of further diligence and dive into from our perspective. And so those are kind of the ways and lenses by which we're looking at it here on our side.
Have any of you all had experiences with your clients who are looking at companies who have taken out PPP loans or had to do other kind of dramatic, make economic decisions that are based on the pandemic, and how do you view any such thing like a PPP loan?
Yeah, we've had a bunch of startups did take the PPP loans. There was so much uncertainty when all this first started that you might as well take it to be safe. And I don't think anyone felt uneasy about that. I don't blame them for for taking that. I mean, we all needed a little help during this time, and some of them. We have a travel software company in particular that was really doing well, growing 25% month over month for about 8 straight months, and that put them on track to raise a pretty substantial round at 3 or 4 times the valuation that we had invested in in a year and a half prior. And then obviously travel kind of stopped, and their growth rate, well, actually the revenue declined, and we knew like their growth rate is probably going to be flat for about a year, and that just changes their entire valuation. I mean, venture valuations are based on pretty much projecting out like you're 3 times as big as you are right now, or something like that. And so they ended up having to just raise, a round at the same terms as the previous round, just an extension of that. But the company, will be able to weather the storm. They have the cash they need. They'll survive. But we certainly saw instances like that, maybe even a few down rounds for some companies. I don't think we had any of those for our portfolio, but people were raising capital, at lower valuations, oftentimes because they weren't going to see that growth anymore. And I don't think any investors, were upset about that. I think we all understood the situation. It was very tough, and now hopefully when things open back up, they can get back to growth and get the VC valuations that we would like to see.
Yeah. And Amanda, Mark, you just mentioned travel, but Amanda, a question for you. We expected to see a number of industries like travel, hospitality, the restaurant industry. We expected to see them struggle due to the pandemic. Have you been surprised by any of your clients who have needed restructuring in the sense that you thought they were in industries that would be somewhat pandemic proof?
I think that it actually has been pretty clear to which industries were going to take the biggest hit as a reaction to all of this. But I think what's been surprising is the companies that have really been presented with this massive opportunity that we wouldn't have expected. I think consumer behavior has been totally uncorrelated to what we would have thought in property management services. I mean, e-commerce is through the roof. The demands for all of that is definitely something that we didn't see coming. There is some surprising, actually we are working with the hotel group right now, but they've been really successful during this time because their concepts are really unique. They manage and operate about 8 boutique hotels throughout Texas and Florida, and with everyone being in forced shutdown mode and being forced to stay at home for quite some time, when we were finally released and things started opening up, at least in the state of Texas I can speak of, I think there was a lot of consumer reaction to trying to catch a break, taking a staycation. You can't travel as much and hop on a plane like you could to get away. These are get in your car and experience a little bit of a staycation type of experience. So really, I also think the experiential concepts relating to even retail and shopping can make it through this time because we're just seeing consumers gravitating towards that.
Michael, can you tell us more about the industries that you typically invest in and if there's been any change in the industries that you focused on due to the pandemic?
Yeah, no, I mean, I think we're quite boring in the sense that we haven't really changed as a result of COVID to start going to chase new markets. I think we're pretty stuck. We're more generalist in nature and really just kind of have 3 industries that we really don't focus on, which is restaurants, retail, and real estate, which, as Amanda said, is really kind of the hardest hit on the, distress side. But I mean, I do think that we're constantly evaluating, I think value opportunities. And so wherever that kind of is, and the interesting thing is from a bankruptcy stat, I mean, you're up 73% year to date, September versus prior year, of which, you've kind of got energy, retail, real estate, and restaurants, which, are 91% up versus same period prior year. And so, potentially things in energy we might look at, but it's not, that's a very tough industry. And kind of where are you on the recovery phase there? And then all the other kind of 14 industries that Bloomberg tracks are up about 58%. And so I think things like industrials up about 30% from a distress play are some areas we're probably more interested in than others. And so it's really finding out what industries are not going away. That's where we really want to play. And that's really why we really focus on strategic viability of businesses first and foremost than the financial engineering piece. And more of those we can find, those are the opportunities that really kind of get us excited.
Mark, I'll put you on the spot a little bit, so no pressure if you don't have many thoughts on this, but Michael avoids restaurants. Do you have any experience in the venture world with investing in restaurants? And if so, or I guess in any event, do you have any idea about the future of the restaurant industry, given there's been constriction recently in it? Yeah, what do you see about the future of investing in restaurants?
Yeah, we've looked at a lot of companies that have point of sale software and different kind of versions of point of sale software that could help restaurants manage all of these digital orders. A trend that we've seen, I've literally seen maybe 6 companies doing this thing where if you're a restaurant and you've got Uber Eats orders coming in and then also DoorDash and et cetera, they used to have a separate tablet for each one of those, and that can become a little bit difficult to manage. So there was literally entire companies starting up that just put all of that into one software interface. I mean, you'd be surprised what kind of niches folks can get into. We didn't invest in any of those. They've done fairly well because there's so much delivery and takeout happening these days. But we do have one investment. It's still very, very early. It's only in the Bay Area right now, but it's kind of a play on ghost kitchens. So ghost kitchens, for anyone who isn't familiar, it's essentially you've got a restaurant, but it's online and delivery only, and then you might even do some pickup, but there's no seating area, there's no wait staff, none of that. It's just a kitchen that's focused on the food. In fact, the founder of Uber has made a big play into ghost kitchens concept. It's called cloud kitchens, I believe. And so we have an investment that's kind of in that same vein. It's basically a company called Unfurl, where the great chefs out there who want to start their own restaurant, they're really good at making the food, but there's a lot more to making a restaurant work than just having great food. There's a lot to it. It's very difficult. And so Unfurl essentially is a turnkey offering for great chefs to be able to launch their own fully digital restaurants. They handle the marketing, they handle the supply chain and logistics, they handle all of the delivery, they even give you the kitchen, everything. So if you're a great chef and you want to start a business, of course you're going to give up some of that equity and give up some of that upside, but now you can focus on what you're really good at. So we did invest in that. It's got a great management team, and we'll have to wait a couple of years to see how they're doing. They're so early. It's early days, but the food looks delicious, and we saw some pretty encouraging data in the early investor updates. But I think that's off the top of my head. I think that's really kind of the only exposure we have to that space. And again, the management team is exceptional. It's actually the company that's IPOing that we invested in. That same CEO who's very involved in this. So he started several companies with over $1 billion in revenue. So we feel pretty good about him figuring it out. Yeah.
So it doesn't have to be limited to restaurants here, but let's kind of call that a pivot that someone made because of the pandemic. What's your criteria and kind of what made you invest in that one that you just mentioned, as opposed to other kind of pivots that companies have made? what's your criteria in saying that looks like it's going to be a long-term profitable adjustment worth investing in?
Ooh. That's that's a tough question to answer because I have my ideas of what I think might happen next over the next 5 or 10 years, but I'm just one guy, and we'll see entrepreneurs, they'll come up with very unique ideas that are just far more interesting than what I could think of. I used to think I had a bunch of cool business ideas, and then I started meeting tons and tons of companies and realized it's tough. And not only does something need to kind of sound interesting, we want to see that in data. We want to see, wow, you're growing really quickly. You're seeing kind of overwhelming demand. So I don't necessarily focus on what kind of pivots the company might be making or what big trends I think might come next. I really focus on the management team being exceptional, and then trying to see that those early signs of product market fit, where they built a product and it's the demand, their revenue is growing really, really quickly with a business model that actually remains defensible at scale. Maybe there's a network effect like Facebook. Every time someone else joins that network, their network gets bigger and stronger, and it's difficult to displace that network for the services that they offer. Or whether, maybe it's a machine learning play where you're gathering more and more and more data that gives you a narrow AI model that's able to do some unique things, and someone else would have to gather all that data that's hard to gather in order to have a model that could be as effective. So that creates some defensibility. There's a lot of different ways to have defensibility, but if you can, I guess, first, it's 90% of it is about the management team. But then we want to see that product market fit, and we want to see a business model that seems to have defensibility, so that you're not just getting your margins, eroded over time as you grow and have success.
So Amanda, from the restructuring perspective, has your work in the last, let's say, 3 months been growth oriented, or is it really just truly distressed and people have to get out while they still can?
It's been a complete mixture of both, actually, right now. We've seen companies that have been faced with a lot of opportunity during this time, as I lightly touched on, but we've also seen companies become stressed as a response to the crisis, and a lot of companies we're seeing be left over levered, and they're having to fix those issues. I think a lot of what Mark says is interesting on the growth-oriented companies. The ones that we're representing right now are well-positioned and not just going to be a fad. These are long-term concepts. I'm sure, Mark, you see a lot of new innovative ideas come to market, or maybe come to fruition that maybe has a lot of demand and performance right now, but is that sustainable in the future? We have one client that we just brought to market that's a tech-enabled auto dealer franchise. They're aiming to bridge the gap between new and used vehicle retailing. The company has been recognized by Ward's Auto as being one of the top e-dealers in the country, and has proprietary e-commerce and technology that offers doorstep delivery throughout the state of Texas. So I don't think that model is going away anytime soon. And while S&P Global has ranked the auto industry as being one of the #1 impacted industries in our country, our client has experienced a lot of growth and demand for their digital offering, and we don't see that going away. I mean, especially our client's trying to enter in and disrupt the used car market, which has been kind of struggling for some time now, with e-commerce driven models such as Carvana and CarMax combating the industry for years. And management recognizes that this is kind of a really ripe time and opportunity to enter in and capitalize on irreversible consumer trends and become a disruptive industry leader. So that's definitely one side of growth-oriented opportunities we've been seeing presented by the pandemic. And on the flip side, I mean, definitely seen some companies that are leftover levered. I mean, one in particular, another one of our clients is in the conference and exhibit management space. Even though they have, they're a really nice sized mid-tier player that has technology embedded in their structure. They are really involved in the e-learning market, but still they've lost 8 months out of their year. And once $100 million company, they'll probably do about $20 million this year at no fault of their own. So they've been provided with a lot of relief and leniency from their creditors, but they still were engaged to evaluate strategic alternatives and bringing in outside capital to sustain their forecasted recovery. So we see that because they're a mid-tier player and they're really on top of their growth strategy for when they do hit their bridge to profitability. They have an amazing track record and amazing management team. They really do deserve to be the ones to move forward and pave the way for innovation. No matter what that looks like, yes, it'll be different, but it will come back. I mean, I think if you believe in the fact that we'll always travel by air, I think you'll also understand that major events and conferences that generate so much value for brands and even municipalities, think of Las Vegas and Orlando, that's not going away anytime soon. So that's kind of, I mean, it is stressed, but you could almost view it as a really opportunistic growth recapitalization opportunities. Like for a equity sponsor, I think that it's a really great opportunity to capture an arbitrage and buy low at or below asset value and ride the wave back up for the next 3 to 5 years, generating a higher return than you could have possibly done in like an 11 times EBITDA multiple auction bid environment.
Thank you. So to plug another ACG event, and a colleague of mine, Jill Lewis, I think next month she is doing a similar event to this, which will be after the election. So Michael, do you have any, have your clients done anything or set any timeframes or deadlines that are kind of oriented around the election?
No, I mean, I think for us, we're a little bit agnostic to that piece of it. But we are seeing a little bit, if you think about, we've actually had quite a bit of influx on our deal flow. And there's a couple of reasons that drive that. One, it's like what Amanda kind of talked about, that, you know, they either really need to sell and recapitalize their business. The other factor, I think, is driving a lot of influx and higher demand for investment opportunities is really, you know, good entrepreneurs that have been able to see, you know, hey, this was not fun to go through, right? I need a partner to help me get through and think through the best next wave. And so that's probably the second piece that's driving demand. And I think the third piece that's really driving demand is people kind of looking at it and saying, hey, what's going to happen with the election, tax changes, uncertainty? We've experienced this in the last election. You know, and so that's what people are trying to get things done by year end. So after Labor Day, we saw quite a big spike to try to get things done by year end, but we're not focused on whether we get something done by year end or not. Our focus is just focused on what's the best next move, both internally and externally, and maybe it's just waiting, maybe it's getting something done, maybe it's not. So, you know, I think we'll be okay either way. I think you start worrying about that stuff, and you know, it's kind of a little bit of a waste of time from our perspective as investors.
And since this is a YP event, I'll ask all three of you the same question, and then we'll turn to the questions that people have submitted while we're on, since we've been on here. So what have you, like, how do you feel like you've brought some value to the table as a YP during the pandemic? And I guess we can also give a shout out to people who aren't YPs. What have you seen some of your more experienced colleagues do, or what would you like to see them do more that would be of help to you as a YP? Amanda, we'll start with you.
Yeah, I mean, fortunately, I have just so many amazing mentors throughout both the ACG community and within my firm that have shown progressive and agile throughout this time. And I think especially for the purposes of restructuring, it's been particularly helpful that our partners have been through past downturns in our history and know how to quickly decipher whether or not a situation is salvageable, and if restructuring is feasible for a business or not. I'm sure at the more healthy M&A level, you look to your partners to make quick decisions on what is a long-term play, what might not be. And I think for young professionals, we can definitely bring speed and agility during this time of major change and innovation. I think that the fact that we've been exposed to so much as a generation as far as growth and technology throughout our lifetime, it generally lends itself to creative and outside of the box thinking. So I think it's a good mixture.
Mark?
Sorry if you can hear the jackhammer going on in the background. They decided to have a construction project outside while this panel's going on. So sorry if you can hear that. I don't know. They're getting better at filtering out noise every day. It's a big tech project that Zoom and Google, et cetera, are working on. Anyways, so yeah, you know, I'm still a fairly young guy. I've only been in venture for a few years, and so you know, I'm not going to be able to tell the startups like, oh, well, you know, back in 09 and back in the .com bubble, you know, this is kind of how it went, and we've been through this before and weathered the storm. I can't give them that messaging. But what I try and do is just, you know, relate to the founders on a more personal level when they're going through hard times like this, and kind of let them know, hey, I know your company may have seen revenues decline 50%, and you know, but a lot of other companies have also struggled. I mean, nobody's going to blame you for this. You know, these are often very, very competitive people that, you know, their companies is everything to them. And I think I'm just able to kind of provide them that broader perspective, since they're so close to their own company and that's all they see. I can kind of tell them, oh, well, trust me, a lot of your peers have seen similar sales declines. Some it's you know, even worse, and let them know that they're not going through this alone. And then, you know, in terms of just being, you know, young professionals, I think in general, young professionals, we've maybe been able to help ease the transition in these organizations for how we can work remotely effectively. You know, we all might be playing the IT professional role just a little bit, you know, helping people get certain software set up and those kinds of things. And you know, kind of on the flip side of that, I think our older coworkers have probably reminded us that, boy, it sure is nice to see people in person. You know, maybe this whole like fully digital world that some of us, you know, might enjoy, it wasn't all that it was cracked up to be in our minds. The old-fashioned way of doing business of you know, meeting in person and all of that kind of stuff, I don't think it's going anywhere. I think you know, the world will bounce back from this, and it's going to look very similar to what it did 2 years ago, in my opinion. And I say that even as, you know, the venture technology guy, like, things are going to get back to normal. We will get through this. But yeah, you know, there's probably some good buying opportunities for distressed assets. We're looking at a few of those too on the private equity side, you know, so it's an opportunity to load up on some stuff that you might not get access to without, unfortunately, you know, a pandemic like this.
All right, Michael, you have the last word on this.
Yeah, I think for me, it's actually not a word. It's just using the thing between your ears and your brain, is listening. I think the opportunity for as a YP to look up and down kind of the chain, that you may be working with and around your ecosystem to say, hey, what are you seeing that I'm not seeing? And what experiences you have. And I've experienced that both on those older than me, having gone through, 10, 15 more years of this than I have. And I've seen really been benefited from people a lot younger than me to see things a little bit differently. And I think that gives us an opportunity to listen, then execute, then add value across different dimensions. And so that's really the exciting thing, is to just pause, reflect, and take it all in, then you can take action, right? So that's kind of what is the good part that I've seen.
Okay, so my job gets a lot easier now. I just get to read questions instead of think of them and direct them and such. We have a question from Johnny, and he says, how have your portfolio companies and clients resisted pricing pressures from their customers or vendors?
So I'll start. I think one of the things that we've been able to do is really, over time, one of our key things at Profit is really driving to low cost. And so we've been really benefited from, really putting the pedal to the metal over the past, 12, 18, 24 months of driving to a low cost position globally with our suppliers. And I think it's really helped us, be in a better position kind of going into this. So we've actually seen growth in our gross margins through it. And a lot of times, I think on the flip side, from, when you focus on, adding value from a lot of these customers, we've actually been able to increase prices on one particular company, actually two particular companies, because the demand is so strong for its products and services. And so we feel, but it is a balance to answer your question. And I think what we've also seen too is just, we're playing the long game on our customers and suppliers, of being able to focus on helping them, because we know, as we kind of talked about, a year from now, 2 years from now, we're all going to be in a better position. And I think those relationships are really going to be the key growth drivers for profitability. But I'm not sure if Amanda or Mark have anything else to add.
I think that that's a topic that is really, really critical for everyone to stay on top of, for companies that you might engage with that have maybe a complex capital structure, especially on the debt side. If they're heading towards an over-levered situation, I think any number of things regarding price fluctuations or price implementing, prices back onto companies that can't withstand it right now, or need to go through some kind of an event to be able to sustain it in the long run. Those are major trigger factors to stay on top of, that could lead to not only financial distress or stress, but operational distress. And at that point in time, it's a lot harder to obtain strategic alternatives and capital solutions that really salvage the going concern of these businesses. And so, I mean, your landlord could go through an acquisition themselves, and, on top of, I still know a lot of landlords that are giving relief and still not charging their tenants. So when you reinforce that rate and then plus maybe put an increase on it, I mean, that changes the dynamic completely, and can domino effect into forced bankruptcy and just a really, potential insolvent situation. A litigious vendor, I mean, definitely having companies always monitoring their cash situation under various scenarios like that, I think is so critical for the viability of these businesses that deserve to live on.
For us, it's been all over the board, because we have so many different companies in so many different sectors. Maybe they had to diversify their supply chain, go from just in time to a more resilient supply chain. A lot of companies were sourcing their consumer packaged goods products out of China, and there were disruptions there. And when you have a recurring revenue model, like a subscription service for, say, shampoo and personal care items, you know, skincare products. You can't afford to miss shipments to your customers when you're trying to have, you know, a subscription business. So, I mean, I think we were mostly dealing with issues like that. Some companies had to drop prices in order to try and, you know, continue to win new business. And then other companies had all the leverage because, you know, it's like a blue collar, you know, learning software solution that teaches you how to, you know, repair HVAC equipment. Like we have a company that we invested at that makes that Interplay Learning, and they've been able to raise prices, and it's just been, you know, absolute gangbusters year for them. It's not like they knew there was going to be a pandemic. Sometimes you just get lucky, but you know, it's something that everyone needs right now that works at, you know, certain businesses. They need to train up their people, and they happen to have the solution for that. So it's just been all over the board. But to try and avoid having to get your margins, you know, pressed too thin, it's just so hard to give a general answer on that, because I can think of, you know, just a dozen businesses off the top of my head that had very different decision-making processes and experiences. It's kind of just case by case.
Okay, we're getting a lot of really good questions, including two from Bill and Garth that are kind of related. So, what type of pressure are you seeing from existing bank relationships for clients that might have covenant violations because of the pandemic?
I think that a lot of companies are in technical default. I'll take this one, by the way. I think we've been dealing with a lot of banks, and I do want to say too that, gosh, I think that they're doing a stellar job for the market conditions. I really feel for the bankers out there, but they're making it happen, and it's been a tough position to be in. But I think moving forward, there is, you know, going to be this benefit of supporting these companies through this time and making them a good credit. I think that does in turn bring a lot of demand for our types of services. We do oftentimes get called in by the lender. We don't ever work on behalf of the creditor. We always work on behalf of the debtors. But putting your best foot forward and running a process to get as close to whole or to par as possible is definitely an initiative worth taking. I mean, I think the creditors with the senior lien definitely have the upper hand in making that happen and delegating that process on behalf of their credits.
And I think the only thing that I'd probably add there is, you know, no one, if it's a good business before the pandemic, it's going to be most likely a good business kind of post-pandemic. So I don't think any lenders are really wanting to write off debt at this time. It doesn't help them. And so I think most people are just willing to amend and extend. And I do think there'll come a time as other businesses start to rebound, you know, and then if that business is still struggling, then I think, you know, it'll be an escalation of conversations. But we've got great banking partners that we've seen, and so, you know, it's actually been, it hadn't been that bad.
I'm going to start using that, amend and extend. That was a nice little moment there. I think we have time for at least one more. Patty asked, or said, you mentioned distressed assets, but we're seeing deals go through without a discount. Are these companies or assets just not being affected by COVID?
Well, yeah, I think I had made that comment, and that's more what our private equity team is looking at. But live music venues, certain hotels, like I'm in New Orleans right now, just on a business trip. We're looking at a few distressed hotels here. And, you know, I think it's those things that, those very assets that you might think, oh, I don't know if I really want to buy that. You know, it might be the time to step in and buy it, because the world might look very different 2 years from now. I think there's significant demand for live music. People, once they're allowed to go back out and go to concerts, are very much going to. We've seen the 18 to 25-year-old crowd is is they're the super spreaders for the most part, because they you know, the virus isn't all that dangerous for them for the most part, and you know, everyone thinks they're invincible when they're that age. So yeah, I think those are some of the distressed opportunities I was talking about, where there are opportunities to get things that either, you know, wouldn't even be on the market and wouldn't ordinarily change hands. You couldn't buy them up; they're illiquid assets, but also get them at a little bit of a discount.
I think unless Amanda or Mike have anything to add to that, we can turn it back over to Kayla. But in any event, thank you all for being here and for listening. I hope that you enjoyed it. Thank you to the panelists as well.
Thank you, Ernest. Appreciate it.
All right.
Thanks.
I knew this group wouldn't disappoint. So that was great information. I think there was a lot of new things that we heard, some things that were like, it's still in progress. We're still going to see where it goes. So thanks again so much to the panel, everything you guys had to say. We really appreciate it. I know we all probably want to clap at home for everything that you've said. We can do one of these. Not audible, but we did record this program and it will be available for viewing soon if you want to share it or go back and revisit some of the comments. So we hope you all will stay on for the networking portion now. We're working on turning back your videos and sorting you into breakout rooms. We'll have 2 rounds of networking and you'll randomly be sorted into groups. We hope